I'd like to introduce our very special guest today, Mr. Morgan Housel. Morgan is a partner at the Collaborative Fund and serves on the board of directors of Markel Corporation, a roughly $50 billion diversified financial holding company focusing on insurance investments and other niche ventures. And Morgan's book, The Psychology of Money, an extraordinary book, which, again, I could not recommend highly enough, sold several million copies and has been translated into 52 languages. He is the two-time winner of the Best in Business Award from the Society of American Business Editors and Writers, and he's also the winner of the New York Times Sydney Award and a two-time finalist for the Gerald Loeb Award for Distinguished Business and Financial Journalism. I've been reading Morgan's content for years and absolutely love what he produces. I share it with everyone I know. So, ladies and gentlemen, it gives me great pleasure to welcome the one and only Morgan Housel. Morgan, thank you so much for joining us.
Thanks so much for having me, Mo. It's an honor to be here. And thank you for you and everyone on this call for what you do. I really admire and respect it. So thank you.
Yeah, thank you. So I suspect, we'll just dive right in. I suspect that when you were a kid, I don't think you had an aspiration of being on Lunches with Legends or kind of one of the most influential financial writers of our time. So when you go back and you look through the arc of history, of your history, getting to this point, who or what were the most transformative events, people that you credit with shaping who you've become?
Well, thanks, Mo. And it's true. Like I had no clue what I was going to do for my entire childhood, my teenage years, even my adult years. Like there's really never any plan other than just kind of being like, oh, this seems fun. This seems enjoyable. Like this seems like a cool opportunity. There's no plan, no roadmap. A lot of it was just kind of blind serendipity how I got here. The one thing I would say, of course, there are people looking back in hindsight, but it's only in hindsight where I'm like, oh, that person, that guy really helped me, but I really only knew it in hindsight. Like one was a guy named John Reeves, who was the first person to hire me as a writer when I had never written anything before. I had absolutely no experience. He was just taking a blind flyer on me. And to hire someone who has no experience, takes a leap of faith. Hiring an established expert is like, that's an easier thing to do. To take a leap on someone who doesn't know what they're doing, that was tough. But without him, I didn't know at the time, but without him, like none of any of this would have ever happened. So that's big. And obviously I could go through other people, my parents, whatnot, but I would say in general, there's like at a high level, people who I've always really admired, which are people who take a long-term career focus, which is like they are intentionally giving up short-term income. They're intentionally giving up short-term, wins and applause, and they're intentionally giving up short-term career build or like resume building for this idea that like, if you can actually take a 10-year view or a 50-year view of your career, it's all going to pay off. I've always really admired that. And I tried to emulate that in my career as well. It's exactly like it is in investing. Like don't chase the monthly gains or the yearly gains, focus on the next 20 years. It's the exact same philosophy in careers, but you'd be surprised how few people take it. And they're always focused on just like, how can I get the promotion this year? What am I going to do this year? It's like, no, actually, if you like take a step back, there's a longer term path to go on. I always really admire that. I also, in an interesting way, I always admired people who quit while they were ahead, people who quit on top, whether it were athletes or Jerry Seinfeld, who canceled his show when it was at its heyday. Jon Stewart did the same thing. I've always really admired people who went out on their own terms versus getting forced out when their career kind of slid down with whether because they aged out or like whatever it be. I always really admire people because what that showed is that they truly had independence. And that's all I've ever wanted in my career was independence. And that goes beyond financial independence. Like people who quit on top, they just say, look, I'm going to go out on my terms. I control this. I'm the independent one. And I always thought that was really cool too. So those are the kind of like, that's been like the people and the ideas who've always kind of influenced me the most.
Yeah, I mean, the concept of going out on top, I mean, one of the things that I suspect those folks need to be able to wrap their head around is like, when enough's enough. And this is a topic that actually comes up with a lot of our families. So, everybody on the call likely has somewhat enough. In other words, every one of our families would be in the, deep into the 1%, maybe in that 0.0001%, so no one will ever go hungry. At the same time, and this is leading to a question here, everyone wants to do the best job that they can They want to see measurable progress. They want to achieve specific goals. They don't want to sit and kind of be satisfied with mediocrity at any point in time. So I guess I just am curious, how should affluent families think about what's enough? Like, what's the equivalent of going out on top? And what are some really important pitfalls to avoid?
I think the idea of enough, it's probably the single most important idea in finance, or at least being satisfied with your finances, like the most important idea in personal finance for sure. And then I think to the extent that it's not appealing to people, it's because people say like, oh, it's never enough, like, because they want more, they want to grow their portfolio, they want to grow their income, and you're like, so to me, the idea of enough does not mean that you have no aspirations for more. I want more money. I want a higher net worth. Like, of course, I think everybody else does too. To me, what enough means is that you understand that if your expectations grow faster than your income, you're never going to be satisfied in not a good way. And so it's just like, you can have aspirations for more. You just have to make sure that your expectations are not growing faster than that. And you see this happen with a lot of people where their income doubles, their net worth doubles, their business triples, but their expectations went up by 4x or 10x, and they're miserable. Not only are they miserable, but what really happens here is that a lot of people, if their expectations keep rising and the level of money that they have is never enough, they keep taking more risk, and then it eventually just blows up in their face. That I think is the innocent version of what happens when you don't have enough. It's not that people are going to keep pushing the boundaries of like morality and the financial decisions that they make. It's that they're going to keep taking risks that they don't need. When the hedge fund long-term capital management blew up in 1998, which, if you're not familiar, it was a hedge fund that was staffed with Nobel laureates, the smartest people in finance. And they went bankrupt in 1998. And Warren Buffett had this great quote where he said, if you risk what you need in order to gain what you do not need, that is foolish. That's the definition of foolish. So you had billionaires who were taking just insane amounts of risk, and it blew up in their face. And if you look back in hindsight, the reason they did it is because they had this mentality that no amount of money was ever enough. It didn't matter that they were billionaires. They wanted to be decabillionaires, centibillionaires. And so that's what happens. It's like, so it's two parts of it. It's A, it's your own happiness and sanity, but B, there's a risk management component to having some idea of enough. There's a very famous banker whose name is escaping me, but one of the most prominent American bankers in the 1870s. He said something along the lines of, I'm going to paraphrase. He said, the death of every bank happens because people are not satisfied with mediocre profits. That's what it is. Like it's not hard to achieve mediocre profits in banking. It's very hard to say that's enough. And then people strive for extraordinary profits and they all go out of business. So that's the general concept.
On a related note, I mean, there's a quote you had in the book, and I just been thinking about it, which is, wealth is what you don't see. Maybe, do you mind just elaborating your words instead of me projecting what I think it means? What did you mean there? And maybe how does it relate to the concept of either enough or wealth preservation versus wealth creation, if you don't mind?
Well, it's just this idea that I can see your house, I can see your car, I can see your clothes, I can see your glorious book collection behind you. I cannot see your bank account. I cannot see your brokerage statement. I have no clue what your net worth is, and I don't need to know. But this is like, wealth is invisible. Because by definition, what wealth is what you did not spend. Wealth is the homes you didn't buy, the cars you didn't buy, the clothes you didn't, the vacations you did not take is what wealth is. It's unspent capital. Now, there's kind of a couple of takeaways from that. One is that it's very hard, particularly for young people, to have good financial role models because you have no clue how wealthy anybody is. There are plenty of people who drive Ferraris and are effectively bankrupt. And there are plenty of people who drive Toyota Corollas and have more money than they ever know what to do with, and everything in between. You really, like, if you see someone driving $100,000 car, the only thing that you know about them is that they have 100,000 fewer dollars than they did before they bought the car. That's all you know. So that's part of it too. But then, like, another natural question is, okay, if wealth is unspent money, what's the purpose of it? What's the purpose of money if you're not going to spend it? And maybe this is less relevant to people on this call who might have high financial resources, but to me, the purpose of it for the huge number of people is, what wealth does, what unspent money does, is it gives you independence. It gives you autonomy. It gives you just options and the ability to wake up every morning and say, I can do whatever I want today. And actually, I'll take it back. I think that is actually very relevant to people on this call, because there are a lot of, for example, CEOs of big corporations who might make $30 million a year and they have no control over their time. Every single second of every single day, they're working 100 hours a week. Somebody else is telling them where to be, what to do, what to say, how to do it. They have no independence. They have no autonomy, even though they're very, very wealthy. And so if at least some component of the wealth definition, in my view, is independence and autonomy. Like if you can't control your calendar, then it doesn't matter how much money you have in the bank. Like to me, you're not getting the biggest benefit that money might be able to give you. And so that's a big part of what of the purpose of wealth, in my view, is. Like, yes, like I like nice stuff as much as anybody. I'm not saying people should live like a monk and, disavow all nice homes and nice cars. But to me, the independence portion of it is so easy to overlook, but it's actually what generates the most amount of happiness to people.
So let's double click on that, because I think you're alluding to the fact, and I agree with you. I mean, certainly by, if wealth is free time, I'm probably the poorest person on this call, but it's, but I attribute that to 5 kids also. So, at least I don't get all the blame, but I agree with you. I mean, all the research suggests the best, that money is best used for creating independence or autonomy versus consumption, and certainly conspicuous consumption. But I guess the question I'd have for you is, number one, is autonomy actually really possible? I mean, if you're married, your autonomy is in question. If you have kids, if you have clients, if you have shareholders, you have employees, like at any point in time, like who really does have, even if capital needs to be managed, that's part number one. Question number two is, how do people actually navigate that freedom? Because I find, and again, my experience working with very successful entrepreneurs who have sold their business, and now they're out and they have nothing but time and independence, and they experience what is arguably the most miserable year of their lives. So how do how do you, number one, is autonomy and independence really possible for somebody that lives kind of in, and number two is like, how do we reconcile that reality that we see as well?
Yeah, so there's some really good points here. One is if you have an entrepreneur who sells their business, makes a ton of money, and they have lots of time, but they're miserable, they're not independent. If you wake up every morning and you're not doing what you want to do, you are not independent. So they have an empty calendar, but they're not independent. They are like beholden to the agony of not working. And so independence, I think when most people think about independence, they think about retirement, not working. And that to me is totally wrong, because the vast majority of people, particularly, in their early life, midlife, when they wake up every morning, what they want to do is work and be productive and contribute to society. And then, so a lot of people they're like, oh, I'm going to retire, particularly like the FIRE movement, the people who are like, oh, I'm going to retire when I'm 28 years old. The huge majority of those people are miserable because they're not independent at all. They are slaves to free time at that point, and they're unhappy. So I think, independence to me, if you are the entrepreneur who likes to contribute, likes to work, likes to be productive, then independence is working on the next business is what it might be. And I'll tell you too, for a lot of these people, they end up with some sense of regret that they sold their business, because they think it was like, oh, now I'm going to retire and be independent. But it's like, actually, it's not what you want. You're actually going to be like beholden to boredom at this point. And rather than being independent, you are like a slave to boredom, which is really painful.
Yeah. No, I would certainly agree with that. Let me come back to investing, and let me come back to first start with the fact that a lot of people who are investing are looking externally for external stimuli for what success means in investing, and some of that. And you've talked a little bit about internal versus external benchmarks. I'd love to hear how you think a little bit about that. Also, why is it so hard for or us individually as investors to just consider what are our goals, have we achieved them, or have we not, as opposed to, what are other investors doing? What's the S&P doing? Why is that so appealing to us? And then what are the challenges that introduces?
A big part of this that I think it's such an obvious point, but it's so chronically overlooked, which is that if you understand compound interest, it's returns to the power of time. The exponent is time. And that's all investing is. And so the exponent does all the heavy lifting. Of course, if you understand the math of compounding, the exponent is everything. And so the question that most investors intuitively want to answer is, how can I earn the highest returns? And that seems like, of course, I should want to answer that question. Of course, that's the path to riches. How do I earn the highest returns? And it's not. Like if you understand the power of compounding, the question you want to answer is, what are the best returns that I can sustain for the longest period of time? That's it. And like the most obvious secret in investing is that average returns sustained for an above average period of time is insanely valuable. If you can earn average returns for an above average period of time, you end up in the top single digit percentage of all investors, like against your peers. And so most investors on any given year, they're like, how did I stack up to my peers this year? If you're comparing fund managers, how'd you do this year against everybody else? It's like, I understand that intuition, but to me, it's just, this is why a lot of people don't achieve the long-term financial returns that they should. They're caught up on the wrong portion of the compounding equation. You should spend all of your time on the exponent, which is just how can I keep this going for as long as I can? And the irony is when people get so caught up in the annual returns that they create so many systems, whether like they're always changing their mind, firing their managers, that they actually cannot maximize the amount of time. They eventually get kicked out of the game. They get scared out. They fire the managers, whatever it could be. And they're not long-term investors. There's an interesting thing for most Americans. I'm sure it's the same in Canada, where for the median household, the best investment they will ever make is their house that they own. Now, is that because homes have the highest annual ROI, the highest annual appreciation? No, not even close. Stocks in the United States have historically produced about 11% per year. Homes are something like 3 or 4. But Americans by far earn the most money on their house. And the reason that is because the house is the only asset that most Americans will ever own that they're willing to hold for 30 years. Whereas the stocks they own, they're going to sell every 6 months. And they just go in and out of it. The home, they're just like, I'm going to buy it and hold it for 30 years. And just because they give compounding a fighting chance to work, it pays off in a huge way, even if the annual returns aren't that great. So I think that's a big thing with like the internal versus external, is that the annual comparison against your peers is all external benchmark versus how long can I stay in the game is the internal benchmark that I think is more valuable.
And so for families and individuals and investors that are actually, are assessing other third-party managers or thinking about other groups, how do they compare them? Because I think that is true on an individual family level, or my portfolio, my aggregate, but that's really my diversified portfolio. But when we think about sort of isolated slivers, how do we think about those benchmarks any differently than perhaps the conventional approaches?
I mean, I would first disclose, and I don't this is not a recommendation for how people should invest, because everybody's different. And certainly a very high net worth family is like a very complex issue. So this is not a recommendation, but I dollar cost average into index funds. And that's what I do. So for my own investing, there's no comparison of money managers. That's just not what I do at all. And the reason I dollar cost average into index funds is because I want all of my focus and attention and bandwidth on endurance and longevity, so I can average returns for an above average period of time. So that's it. Right. So it's really not my expertise to say like, here's what you should look for in different managers. But I would say this, the amount of time that a manager needs, that like the track record that they need to separate luck from skill is much longer than most people think. In order to look at a money manager and say, oh, that person's above average returns are skill, you really need to look at how they did over multiple market cycles. And a lot of market cycles last 10, 12, 15 years. So this is like the irony of like, how can you really tell that someone is successful? In my view, it's like, well, what is their investing track record over the last 30 to 40 years? Well, how many managers have a 30 or 40 year track record? Like virtually none, because if you're successful for 30 years, you retire. If you're successful for 10 years, you retire in this business. So it's a really difficult thing. And there are plenty of money managers who can say, oh, my track record over the last 3 years beats 95% of my peers. And it's like the odds that was attributable to luck or whatever you want to phrase, forces outside of their skill, outside of their control, are really high. And that's why the turnover in money managers is so great. You have people that have these 3-year streaks that are really good. They attract a ton of money. They invest into it. The streak ends. The money all flows out to somebody else. And it's just all the capital is just ping-ponging back and forth between people who got lucky at some point. So that's the hardest part about sizing up money managers, just the amount of time that you need to judge them.
So just apropos to that comment, like obviously, I mean, you've written about many great investors, perhaps met some. Who do you regard as, number one, the greatest investor of all time? And I would just, as a related note, I think you've commented that obviously you sit on the Markel board, company headed by Tom Gaynor, who's, again, one of today's exceptional investors. separate as who you think is some of the one of the greatest investors, why is Tom as exceptional as he is, and what is exceptional about him?
I would say what's exceptional about Tom. I mean, I would first state that Tom's audited track record is 40 years of outperformance. So like he is one of the few that would fall into the category of like, if you outperform for 40 years, which includes everything from 1980s inflation to 9/11 to the financial crisis to COVID, like if you've outperformed in all of those environments, it's pretty easy to say that is skill. I think what makes Tom great is that he, in a very beautiful way, he's not attracted to the external scorecard. I don't think he could care. I don't think he could care less about what, certainly like, has he underperformed this quarter or this year? And it's one thing to say that, it's another thing to actually watch him in action and go through a period where he might underperform this quarter, this year, and zero impact on his psyche in a way that I think is so rare and so beautiful. And that's why he's in the position he's in. Like, who do I regard as the greatest investors of all time? These are household names. This will not surprise anyone, but the reasons might differ. Is Buffett and George Soros. The reason I think they are the greatest is because they have outperformed in different investing, in different asset classes, in different environments. So Warren Buffett has made money on everything from bonds to commodities to buying whole businesses to buying small caps to buying mega caps. He's done it in high inflation environments. He's done it in negative yielding environments. He's done it in everything imaginable. So it's really difficult to say, oh, he just got lucky because of this one little sliver of a thing. George Soros is the same, even more so for George Soros because he's such an active trader. He's not really doing it anymore, but he made it, like, name any asset class in the world and George Soros made zillions of dollars from it. They pick any economic environment and he made $1 zillion during it. And that's when you can be like, if you're that diversified in your skills, you know what you're doing. George Soros is actually really interesting because he has attributed a lot of his success as an investor to this completely asinine idea that he says when his back starts hurting, he knows a recession is coming and he should sell. And you're like, what? That's like, so he's like, he's a quirky character as well. But most of my admiration for all these guys just comes down to how long they've been doing it for.
Right. And I think in your book, and I forget if it was Julian Robertson or somebody else, you mentioned comparing them to Buffett, stating like Buffett doesn't actually have the highest IRR, in any given sort of 5, 10, 15, 20-year period. But when you compound it over those decades, it's kind of interesting. But what comes to mind is like Buffett and, I haven't read much of Soros, but certainly individuals like Howard Marks and others, when they talk about investing, it's so clear and it's so thoughtful. And frankly, when you write about it as well, and it all seems so logical and simple, though when it gets to the execution, it's really, really hard, right? And it's really complex. So everybody reads it, everybody quotes Buffett, everybody looks to guidance to these investors, but very few have anywhere near their returns. And I think it's more than just time. So like, what else might explain the gap?
I think at the individual level, it's much easier to say, I will be greedy when others are fearful than to actually do it. And most people who quote that line, be greedy when others are fearful, quote it during a bull market. And everybody during a bull market thinks they have a high risk tolerance. Everybody thinks, oh, if the stock market fell 30%, it would be an opportunity and I would come in and buy. The number of people who actually do it is 99% lower than the people who think they will do it. And I think that's an interesting point, that people actually have a very poor view of how they will respond to risk. They think, oh, if the market fell 30%, here's how I would feel and here's how I would react. And when it actually happens, it doesn't. I think the reason that is because when things are going well in the market and the economy, and you say, hey, let's imagine a world in which the Dow falls 30%. How would you feel? In that situation, you imagine a world in which everything is the same as it is today, except stock prices are 30% cheaper. And in that world, you're like, oh, that would be an opportunity. But that's not how things work. The reason the stock market might fall 30% is because there's a new virus that might kill you and your family and is shutting down the global economy and is bringing in the second Great Depression. And in that context, you're like, oh, actually, I want to keep some cash around. Right. And so it's very hard to contextualize what actually might make the market fall 30%. And there's this great phrasing I heard a couple of years ago. I forget who said it, but someone who was close with Warren Buffett said, people say that Warren Buffett is unemotional, and it's not true at all. He's counter emotional. that during those moments like 2008 and COVID, it's not he's unemotional, he's extremely excited. And he's like, he gets very emotional of this, like, oh, this is it. This is the time to strike. And that is like a very rare personality. I think most people are emotional. Some people are unemotional. Very few people are counter emotional, but that's what you need for something like that. And at the professional fund manager level, it gets even harder, because even if you as a fund manager say, this is a great opportunity, I want to buy, if your clients don't buy it and they're pulling the money out of the fund, your hands are tied. There's nothing really you can do with it. So I think there are a lot of fund managers out there who get it and they understand the Buffett strategy and philosophy, but the cash flows that they can actually put to work are not dictated by their thoughts. It's dictated by their clients, whether they want to, and the clients by and large are going to give you money at the worst time and take it out at the worst time. That's how this works. So that's why it's just much harder to put into practice than it is to do.
Yeah. And I want to come back to a bunch of things you mentioned, including Buffett's kind of exceptional counter emotionality. But, one of the things that, again, you've written about is that even for the Soros and even for the Buffetts, and even though they've had this great diversity of having made money in every asset classes, you've talked about the fact that a lot of their performance actually comes from some of their outliers. In other words, the greatest investor successes are driven by some tail events or a small number of successes that make them look brilliant. Is that actually true? Is that supported by the data? And if so, then is striving for exceptionality even possible? Kind of what's the upper limit of what sophisticated investors, well-advised investors, but like normal people could actually strive for?
It's definitely true. It's definitely documented. And the most extreme example that is kind of jarring to read about is Benjamin Graham, who's Warren Buffett's early mentor. He's the father of value investing, and he was a very successful investor himself. He wrote the book, The Intelligent Investor, and it's actually like the postscript in The Intelligent Investor, which most people didn't get to. But the very, very end chapter, Ben Graham says something extraordinary. He says he knows a person who is a very successful fund manager, and 100% of their career success is owed to one stock that investor purchased. And that one stock broke every single rule that investor laid out in terms of here's how you should invest. And like the last line of The Intelligent Investor is that investor is Benjamin Graham. It's himself. If you look at Benjamin Graham's career, very successful investor, 100% of his success is owed to one stock, Geico, that he started buying in the 1940s or whenever it was. And if you take out Geico from Ben Graham's track record, his track record is average. And it's actually the same for Berkshire Hathaway. Munger has said, and he said this kind of glibly, I don't know if this is like the exact numbers, what it is, but he said, if you take out Berkshire Hathaway's top 5 investments, its track record is 0, or its track record is average, I should say. And so that's, Berkshire has made literally hundreds of investments, and 5 of them account for 100% of the outperformance. Interesting there too. One of the companies that is in those top 5s is Geico too. So it's like Geico is single-handedly responsible for Benjamin Graham's career and Warren Buffett's career. It's like that's kind of astounding to think about. George Soros is the same. He very famously made several $1 billion when he shorted the pound in the early 1990s. Of like everyone is like this, where if they make 100 investments, 90% of their success comes from 5 or fewer, maybe even 1. But I think that's actually, if you look around how the world works, you see that distribution almost everywhere. It's true for companies where Apple's toyed with every product imaginable. They've tried to do everything. They've made, computers and iPads, whatnot. All of their success comes from basically one product, the iPhone. You look at Amazon. Amazon has tried everything. They tried to make the Kindle Fire phones. They tried everything. All of their success comes down to 2 products, AWS and Prime. And so everywhere you look at it, there is like tails drive all big returns. Whenever there is outsized success, you're going to see a tail-driven distribution playing a huge role. So rather than like, oh, that's going against it, it's just like, that's just how the world works. And it's hard for investors to wrap their head around that too. Same for if you hire 10 fund managers, if you do a good job, you're going to earn most of your returns from one of them. And it's not realistic that anyone is going to make 100 investments and have all of them work out, unless you're talking about like treasury bonds or something. It's just in any tail-driven business, like equity-driven business, it's always going to be that distribution. But it throws a lot of people off, because most people, if you make 10 investments and 8 of them are flops, you feel like you failed. You feel like I clearly made a chronic mistake here. And by and large, it's probably not true. It might be true, but by and large, it's probably not. It's actually like that's how the world works. It's just a hard thing for people to understand.
Yeah, it's kind of like Pareto's principle on steroids.
On steroids, yes.
It's remarkable. So it's not actually luck. It's just kind of almost like a law of human nature. We just haven't had a way to quantify it yet. But no, that's interesting. So I do want to come back to the exceptionality. I mean, when one of the things that again, it's very easy to look at people that are exceptional, admire them, admire their lifestyle, admire who they are as people, and whether that's Buffett or Dalio or Sam Zell or David Tepper or whoever, and it looks like they have it all brilliantly together. But you've had a couple of interesting points about that rarely being the case. Again, you're dealing with people who are exceptional on this call. What does that mean for those greatest investors? What does that mean? What do you also see, which most people take for granted when, or most people miss when they kind of admire those kind of living legends of the investment world?
I would almost go as far as to generalize and say the most successful people are very rarely the happiest. And there's this quote that I like too, that like the best position to be in is rich and anonymous. And being rich and famous has a lot of downsides in it. If you can be rich and anonymous and kind of maintain that normalcy connection to the world, I think that's part of the balance too. So that's been kind of jarring for me to dig into. Is like a lot of these people that I really admired, if you actually see the full picture of their life, you're like, oh, actually, I don't think I want that for myself.
Interesting. So just, I mean, on the topic of the price of exceptionality, I just want to take a slight detour and talk a little bit about the price or the fee of returns. And, you have an interesting kind of approach to this where you've distinguished between a fee versus a fine as a driver for better decision making. Could you maybe elaborate on that and share what are some of the mistakes that people make as a result of not making that distinction? How do you accept being wrong, making mistakes, seeing losses part of the process, all of that jazz? Would be great to hear your thoughts.
To me, the idea was like, okay, so for anything that's valuable in life, there is a fee you have to pay. There's nothing is free. That should be pretty obvious. And so most people think about investing returns when they think about, oh, what's the fee? They're like, oh, what is the fee that I pay my money manager? What's the AUM fee? It's like, no, that's not the cost. That's not the fee. The fee, if you want good investing returns, is putting up with a constant chain of uncertainty and volatility and not knowing what's going to happen next. That's the cost of admission. Now, most people, when they experience volatility in the stock market, they view it as a fine. And a fine means you did something wrong. Like you made a mistake. Here's your fine. Here's your speeding ticket. Shame on you. And it's not, if you view it as a fee, it's just, this is the cost of admission that I need to be willing to pay in order to do something great over time. Then it makes a lot more sense. And like when you experience the inevitable volatility, it's not that it's fun or you enjoy it, but you're like, oh, I need to be willing to pay this bill in order to get something great in return. And so I think that's just like the very simple distinction between the two and why so many people get it wrong when they view volatility and uncertainty as a fine. And if you're hiring other professional money managers and they lose 30% of your money, that's like worse than a fine. That's like capital murder that you've committed as a money manager. When the actuality is for the vast majority of the time, it's just like this is just the bill coming due. And if you don't have a good grasp on what the cost of your success is, then you don't understand it when the bill comes due. Very similar in like a successful career. What is the fee that's demanded for a successful career? A lot of times it's long hours and uncertainty and bureaucracy and putting up with all these things that when you view it as like, when you experience it, it's like, how can I get rid of this? And there are some of that's great, but by and large, it's just like, that's the cost of admission for the ultimate success that you're going to get.
And so like, I'd be interested in hearing in how you distinguish that from actually just getting paid for the risk undertaken, right? And so if there's any nuance there. The other thing I just would love for you to touch on is, and you quoted your buddy Carl Richards in saying that, risk is what's left over after you've thought of everything. And that line struck me because then it's like, well, okay, then how do you manage risk? Like, after you've thought of everything, how does risk management work? So I'd love for you to riff on that if you don't mind.
Yeah, it's just the idea that people, if you look at the economy, people are very good at predicting what the economy is going to do, except for the surprises. And the surprises tend to be all that matter. So that's why the history of economic forecasting is so bad. It's not because we're not smart enough. It's just that by definition, you cannot predict a surprise like COVID or 9/11 or whatever it might be. And so to me, the anecdote for that, like if we are in a world where the biggest risk is what nobody is talking about, how can you prepare for that? To me, the only way is that you should have a level of conservatism in your finances that feels like it's too much. Your level of liquidity and your debt levels should feel like they are too conservative, because that's when you at least know that you have a fighting chance of being prepared for something that you can't even fathom. If you are only saving for the risks that you can envision, by definition, you're going to miss a surprise every single time. And a lot of companies fall for this. A lot of people fall for this too. And they're like, oh, like I've done a risk management assessment and these are the risks that I'm facing, and I have enough liquidity or insurance or whatever it might be to handle those risks. You're like, okay, but look at the history of risk. It's always something that nobody saw coming every single time. In any given calendar year, the biggest news story is something that was completely unpredictable at the beginning of that year. Every single year, it'll be like that going forward as well. So, you know, I do this for my own finances. If you look at my level of cash relative to my net worth, anybody would look at it and say, why is it so high? Like, what are you preparing for? Are you saving this up for this event? And I say, no, I have no clue what I'm saving that for. I'm saving it for a world in which everybody is constantly surprised by what gets thrown their way, whether it's individually, whether it's a medical issue or a divorce or a job loss, whatever it might be, or macro, like 9/11 or COVID, these like massive events that upend everything. Like one stat from that was, I remember in 2010, which is when the unemployment rate peaked after the financial crisis. I think it was like unemployment benefits would last 26 weeks, something like that. And the average duration of unemployment was like 29 weeks. Like it was longer than they would last. So it was like, even if you have a safety net and it's still inadequate given what so your safety net should always feel like it's too much. That's when you know you're doing okay.
Right. And just on a related note, you know, a lot of how we think about risk is going to be a function of our experienced lived history, right? Like, and that's how we think about risk management. And so rightly, I mean, as it happens, it's been exceptional that we had sort of COVID in our lifetime, because it's like kind of the paragon for always unexpected sort of recent history. But how do we, but I think what we forget in that process is that our lived history is an insignificant fraction of actual history, and that our future is almost assured to be somehow different than our past. How should investors be approaching that, and avoid that trap of defining risk management by our recent or lived experience?
I think a lot of myself, because I consider myself a history buff. And what do I consider history in my mind? This is going to sound ridiculous, but in my mind, history in my mind is the United States from the Great Depression on. That's my definition of history. I know that's wrong, but that's when I intuitively think about it. That's what it is. Like just the United States. I was listening to a podcast last night with Tim Urban, and he made this point that even if you broaden that, most people's definition of history is from AD on, the last 2,000 years. And he made this point that actually human history is 100 times longer than that. So even if you're like, I'm going back to AD, you're getting 1% of human history. That's 1% of it. I guess from a risk management perspective, it's just like, whenever, particularly in investing, whenever we're like, oh, the worst case scenario is the Great Depression. The worst case scenario for inflation is the 1970s. It's just like, no, that's completely false. Like it can be so much better. It can be so much worse or better, because we also say like, oh, the best case scenario is the 1950s or the 1990s. Like that's like peak economic prosperity. Like, no, like we actually don't know what peak economic prosperity. We could actually go through a period where it's way more prosperous than that, because before the 1950s, we thought peak was like the 1920s. And before the 1990s, we thought, like, you're always ratcheting up these new levels of bad and good, these new records. And so we have no idea where the boundaries for optimism or pessimism are. I think that's the humble takeaway when you expand your definition of history.
So I want to come back to the optimism, pessimism thing, but there was one topic I wanted to cover, which I want to make sure we don't lose sight of. You know, there's a dynamic today when you look at the firms, and it doesn't matter whether it's BlackRock, Vanguard, Brookfield, Blackstone, whoever. The big firms are getting bigger and bigger and bigger. And one of the things that you talked about, and there's good research behind it, that the sort of the odds of outperformance seem to decrease. So like, as companies get bigger, the prospects of returns go lower, maybe the risk goes down. So my question to you is, number one, is there any way to avoid the downside of big? And number two, as you think about AI and the competitive advantages that larger firms have in terms of having more capacity to invest in technology or infrastructure, does any of that counterbalance the sort of the lower return prospects? Or does it just extend that time horizon? As you said earlier, if you're just in the game for longer, you actually could have greater returns over time, and might being big contribute to that. So I just wanted to get your thoughts on that.
I think, can a company avoid like getting bureaucratic as it ages? I think the answer is yes, but can it become big and old, like a company like Apple or Google or Microsoft, and avoid it? Much, much harder. So there's actually a lot of profiles out there of the oldest companies in the world, and a lot of them are in Japan, and they're literally like 700-year-old sushi restaurants or something like that. They've been around for like operating consistently for 700 years, but they're tiny. It's a tiny little place. Can you scale while you're doing it and keep that going indefinitely? Like, the evidence for that is extremely, extremely bad. Some of the examples would be something like ExxonMobil, that is a derivative of the Standard Oil empire that was built in the 1880s, that are still a very big, prosperous company. There's a few others, but General Electric is the most telling example of, like, you could not. The other is Sears. General Electric and Sears probably had the biggest economic moats of any company that existed in the 20th century. And both of them are either bankrupt or just a tiny fraction of a shell of what they used to be. And it's so hard for us to envision today that in 30 years, Apple, Google, Microsoft might be either out of business or just a comical shell of what they used to be. But that is the path of it. And it's almost like saying, can a human become 100 years old and still be as dynamic as they were when they were 25? Like, no, it just doesn't, just the laws of physics don't really work that way. And I think there are business laws that are almost as powerful as the biological laws of a human aging. And because by and large, what made those companies great when they were smaller and younger is just an entrepreneurial dynamism that just you cannot maintain when your company employs 3 million people and operates in 200 companies or 200 countries. So it's extremely rare. I would say the one company that has pulled it off the most impressively is actually Microsoft. That was, it's coming up on 50 years old, and it really reinvented itself over the last decade and is a $2 trillion company today that is just enormously profitable. There's this quote from Bill Gates in, like, I think it's like the late 1980s, where Microsoft at the time had like 30% profit margins. And he said, like, look, this is great, but no company can maintain 30% profit margins. And 40 years later, it has. Like, that's very, very rare to keep it going for half a century. So it's not impossible, but it's extraordinarily rare.
Right. And do you know what contributed to that?
Maybe some sense of natural monopoly that Windows has had, but now all Microsoft's success is like cloud and other stuff. Windows is actually a very small part of it. And I think a lot of that too is, they pulled off what is very rare too, which is a successful CEO transition. And Steve Ballmer, I think, is a wonderful person, but Bill Gates, very successful CEO. Steve Ballmer, like, okay. Satya Nadella, incredible, like once in a century kind of person. That's very difficult to pull off.
No, I would agree with that. Just on the topic of size, I mean, and I know that, and you mentioned it here and other places, that your personal approach has been to simply index your capital and so that it's brainless for you, and you can kind of give yourself the best chance of compounding over time. And by the way, Warren Buffett also recommends it for the vast majority of the population. This is the right move. One of the things that I'm curious about is, at what point is indexing too big? And so obviously we've seen huge repositioning over the last 10, 15 years out of active to passive management. And in fact, based on the data that I recently saw, it seems passively managed assets and indices and ETFs have now overtaken actively managed funds. So what happens? So what's that crossover point in your mind? And what happens when most of the market is indexing? Is that conceivable? Is it like, or is it a strategy with an expiration date?
I would say that, look, is it conceivable that indexing could get too big? Yes. I don't think it'll ever happen because it is so ingrained in the human condition to want to do better than average that I don't think we're ever going to get to a point where 90% of investors say I'm satisfied with average. You're really fighting against the biological urge for people to compete at that point. So I don't think it'll ever get there. And it's not close to there right now. Like indexing as a share of global wealth, it's big. It's like in dollar terms, you'd be like, oh, there's $50 trillion invested. Like, yeah, but the global, investable capital is something like $300 trillion. It's still like a pretty relatively small portion of it. The other thing is, I don't think you need that big of a percentage of investors to be active for there to be so-called price discovery, for companies to be like priced based off of their fundamentals. And even in the massive indexing explosion that we've had over the last 10 or 20 years, there's still a lot of market dislocations. It's not just like, oh, every stock just consistently goes up. Like it's not, it's still very easy for a stock to miss earnings and fall 50%. That happens as much as it used to. So if we got to a point where it was just, oh, like every stock goes up 1% per month and its quarterly earnings don't matter at all, then you could say indexing is a problem. We are so far from that. And I don't think we'll ever get anywhere close to that.
And I mean, I think the other piece that, and it just coming back to indexing, I mean, one of the things that we've seen a little bit more is that you do have the entirety of the market could be, effectively one trade. What does that do in your mind's eye for sentiment? So, for example, today we're seeing, and again, pessimism sentiment shifts, but like between the geopolitical risks, the demographic challenges, inflation, sustainability, all of these mental health challenges, etc. Like as sentiment shifts negative, what does that actually do for an indexing strategy as opposed to sort of a market that's a little bit more balanced, even if indexing is only say 50% of the market?
I think what's cool about indexing is that the vast majority of the people who do it, at least in the United States, are investing out of their 401ks, their retirement schemes that they have. And most of those people don't even know the password to their brokerage account. They're just every paycheck, it takes out a couple $100 and puts it in their 401k, and it is utterly out of sight, out of mind. And whether it's optimism or pessimism, it's completely it's not part of that equation. That's what I think is great in it, because that style of investing, in my view, is particularly for ordinary, just your average median family, is by far and away the most effective way that they can invest. So in many ways, but the other things, like the things that you brought up that are very real, demographic challenges, inflation challenges, everything that's going on in democracies around the world, all of those, none of those are necessarily new. They all have their own little modern flavors to it, but there has never been a period ever, and there will never be a period ever, where you can take a rational view of the world and say everything is great right now. It's never really been the case. So optimism, pessimism, they go through periods like the 1990s where optimism really reigns, and it's like people are, they're overly optimistic. But that's not because things were actually better in the world. It's just because people's view of risk becomes distorted over a period. Like you can make a case that on September 10th, 2001, the day before 9/11, the risk of a terrorist attack was enormous. We just didn't know it. Everyone was oblivious to that risk.
Right.
And in January of 2020, the risk of a pandemic was enormous. We were just oblivious to it. So what changes is not the actual uncertainty in the world. It's just people's perception of it.
And so I just double click on that. Like, and again, this is not a social policy or economic kind of question, but if one of the great books that I've come across is The Rational Optimist, and I forget who wrote it, but anyway, the basic premise is that any time in history, if you were to take a snapshot of what was going on 50, 60 years ago, it doesn't matter how glorious the 50s were. Today, by any account, we're better than them, and you could do that since going back to time immemorial. I think some of the questions that are posed today is, as the world was in a very fortuitous place for like a long time, where we were like globalizing, rates were coming down, taxes were coming down, GDP was growing, we talk about demographics and so on and so forth. A lot of the shifts that are occurring today seem to actually, for the first time in a long time, take us back. Would you agree with that? Would you disagree with that? And if so, what does that actually mean for investors and people that are thinking about markets?
One thing I'd say is a lot of it times when we look back at optimistic periods, the 50s and the 90s, yes, there was a lot of optimism, but there's a lot of nostalgia when we think about that too. A lot of like false nostalgia. If you go back to the 1950s, yes, they were a very good people for, there was a great, very good people for like, it was a good period for white men. Basically, but there was so much racial strife in the 1950s. There was a lot of uncertainty with, the beginnings of the Cold War and the Korean War. Like, there's actually a lot to complain about in the 1950s. In the 1990s, there was, crime was a major issue. Bill Clinton was being impeached, the hole in the ozone layer. There was a lot to complain about in the 1990s, and even economically in the 90s. There's a big interest rate spike in 1994. There was the currency meltdowns in 1998. Like, even during the glorious 90s, it's easy to forget how much uncertainty then there was. Whenever you look back in hindsight, it's impossible to unremember what you know today. And so we know in hindsight that the 90s ended great, but in 1994, we didn't know that they were going to end great. We thought things might blow up any day. And so I think in many ways, the uncertainty that we feel today has always been around. We just, like, when we look in hindsight, we know how the story ended. So it's impossible to remember that uncertainty. So that's a big part of it. But, if I were to say, are the macro challenges that we face today more than they have been during the average period of the last 50 years? Off the top of my head, I'd say no, absolutely not. There's a lot of challenges, but there's always been a lot of challenges. Right. There's never been a period where there wasn't. And I don't think what we're dealing today, they're very serious challenges today that are going to be painful for a lot of people, including maybe everyone on this call, but that's always been the case.
And so, very interesting. So I know we only have about 4 or 5 minutes left, and maybe I want to just turn to the topic of advice. And I have just a few quick questions on it. So number one is, like you said, there's, I think in the book, there's no such thing as universal advice, and we know it, right? That's relevant for everyone because everyone is so different. And that goes for investing, psychology, relationships, whatever. At the same time, part of what you're striving for in your writings is actually to offer something useful and practical and helpful for people. So how do you distinguish between advice and or useful ideas, principles, etc.? Start there.
I would say, look, I think if there is a piece of advice that I would give for people financially, it's that to make sure that you don't view finance like it's math where there's one right answer for everyone. It's a soft skill where everyone is, even like equally educated and informed people will come to vastly different conclusions about what you should do with your money and how you should invest, how much you should save, how to donate money. Equally informed people come to totally even opposite conclusions, and that's fine. I think finance is much more, it's closer to something like your taste in music, where there's not a right answer. It's just, you like this, I like that, and to each their own. And so the advice is to become more introspective about who you are versus trying to seek out the right answer in a textbook or even from an advisor. There are a lot of very good, informed, educated, credentialed financial advisors who might give the advice that is right for one person and disastrous for the next person. You really just got to figure all this out for yourself. That's the one piece of advice that I would give that is universal.
So let me ask you, just maybe end with this one question. It's a two-parter. One, what was the most useful piece of advice you've ever received? And two, and you could go in any order, what's the worst advice that you see people receiving that you wish they didn't?
Yeah, I would kind of extend from my previous answer and say the best advice, just general advice, was go your own way and figure it out for yourself. That's really hard advice to achieve because everybody wants a playbook, everyone wants a map, but just like, hey, you got to figure this out for your own. And on the extension of that, the flip side is the worst advice is, here's what you should do. Let me tell you the path you need to go on. Let me tell you the route you're going to take. Let me tell you why you're doing this wrong. And I'm glad I didn't take a lot of that, particularly for writing, which I consider in art is like, there's no right answer. You just got to like, you like this writing style, I like that writing style. People who in my career said, hey, Morgan, you should write differently. You should write about a different topic. And I always thought that was just like, no. Like that might be good for you, but this is what I like to write about. So I'm going to do that. Thank you very much.
That's great. Just any last piece of counsel, guidance, thoughts, ideas for affluent families, family offices, ultra high net worth investors? That's any last parting words?
This will be like going down we could talk about this topic forever. I know we're out of time here, but I think the most useful comment that I've heard about wealthy families comes from Warren Buffett, where he said, leave your kids enough money so that they can do anything, but not so much money that they could do nothing. That's, if I look at the financial flaws that wealthy families tend to make, the common denominator, it's not appreciating the wisdom in that Buffett quote.
Fantastic. Morgan, that was awesome. Thank you so much for joining us today. Thank you for sharing your incredible insights with us and really being so generous with your time and wisdom. And we really appreciate it and hope we could do it again soon. So thank you.
Thanks so much for having me, Mo. I appreciate it. And thanks everyone for joining.